Hi guys. Today we will analyze UGI Corporation stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive, the short-term trend is negative, the long-term trend is negative. There should be more interesting stocks out there. Support level is around $37.30. Next support level is around $32. Resistance level is around $46. In the last month the stock has been trading between $36.50 and $46 range. It is currently trading near the lows of this range. The stock has an average volume of 1.3 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 8% per year, for last 5 years. We see that the average profit margin of the stock has been around 8% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 71% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for UGI Corporation: bad, average, and good. First scenario. UGI Corporation will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 2%. Future profit margin would be a low, 6%. Future free cash flow to net income rate would be a low, 40%. In this case, the fair value of the stock today would be $24. Second scenario. UGI Corporation will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 3%. Future profit margin would be average, 8%. Future free cash flow to net income rate would be average, 50%. In this case, the fair value of the stock today would be $41. Third scenario. UGI Corporation will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 4%. Future profit margin would be high, 10%. Future free cash flow to net income rate would be high, 60%. In this case, the fair value of the stock today would be $64. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 4.87. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For UGI Corporation, analysts forecast growth rate around 4% per year in next 5 years, and future P/E around 13. Again, I will use 3 different scenarios for UGI Corporation: bad, average, and good. First scenario. UGI Corporation will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 2%. Future P/E would be a low, 8. In this case, the fair value of the stock today would be $17. Second scenario. UGI Corporation will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3%. Future P/E would be average, 12. In this case, the fair value of the stock today would be $27. Third scenario. UGI Corporation will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 4%. Future PE would be high, 16. In this case, the fair value of the stock today would be $40. As you can see, today the stock is fairly valued, $38, if we expect the company's high performance in future. It's not a flashy stock, but its dividend yield is enticing, 3.56%. It's a well-run company with good fundamentals. And the stock is fairly valued at the moment. However, the company's future growth is limited, 4% on average over the next 5 years. I may open a small position next week, just for the dividend, and I'll buy more if the stock goes lower. Company's strengths. UGI Corporation is an electric and natural gas utility that operates in the state of Pennsylvania, and distributes propane and liquefied petroleum gases, LPG, both domestically and internationally. The company also manages midstream assets in Pennsylvania, Ohio, and West Virginia, and markets renewable natural gas in 12 states and Europe. The company is moving into renewable energy, as it has committed over $100 million to renewable natural gas projects in the United States. Renewable projects enable UGI to utilize its existing infrastructure and require no incremental costs to customers. The company pays a well-covered dividend, 3.56% yearly, that's set for continued growth in the foreseeable future. UGI's return on assets of 6% and return on equity of 20% are amongst the best returns of the industry. UGI has a profit margin of 13%. This is better than the industry average of 10%. Risks. Risks include potential for asset impairments if projects hit roadblocks. This was the case on UGI's Penn East project, for which it ceased development and had to take a 44 cents per share impairment charge. In addition, warmer than expected weather may reduce natural gas deliveries, and future rate increases are subject to regulatory approvals. The revenue is expected to grow only by 4% on average over the next 5 years. Based on estimates for the next 5 years, UGI will show a small growth in earnings per share. The EPS will grow by 8% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.